Welcome to the Spheria webinar. My name is Mark Cormack from Pinnacle Investments. Pinnacle are equity partners and work alongside Spheria to distribute Spheria's funds to the Australian financial advisory marketplace. And today I'm delighted to be joined by the founders and lead portfolio managers of Spheria, Marcus Burns and Matthew Booker, who are going to outline some of the insights and investment trends they're seeing in the Australian small and micro-cap part of the market. It certainly has been an interesting time, and there's been a huge volume of money moving around in this space, and the guys will discuss why microcaps in particular have washed out, and as always the team will take you through some of the businesses that they see delivering great cash flow with strong balance sheets at decent valuations. In brief, Spheria are an independent fund management boutique who specialise in Australian small, micro and mid-cap investing. Establishing the Spheria Microcap Fund, the team have delivered 10% return, the Small Cap Fund has delivered 11% return, and both of those funds have outperformed the ASX Small Ordinaries and Emerging Companies Index since inception. In addition, many of investors or our listeners are probably not aware that the Spheria also run their Opportunities Fund, which is more of a mid-cap fund that can go anywhere, investing in mid, small and microcaps. And this fund has been running since 2016 and has been able to deliver a return of 12% per annum. Just finally, on the investment suite within the Spheria Fund Management Group, the team also run a listed investment vehicle, a direct equity called SEC, which is also available for those investors who prefer a direct equity option. Before we kick off, a couple of quick housekeeping items. Today's presentation should last around 10 to 15 minutes and will be followed by a Q&A session where all attendees will have the opportunity to ask questions, and that can be done by clicking the chat box on your screen. So without further ado, I'll hand you over to the Spheria portfolio managers, Marcus Burns and Matthew Booker, for today's presentation. Thanks, gents.
Thank you, Mark. It's Matt Booker speaking. If we go to slide 2 and look at the performance tables, what we've seen in the markets is a very volatile share markets, globally and domestically. You saw a big correction December last year, and you've seen a big rally out of that early this year. And our funds have rallied with those markets. Where there has been some weakness for us has been in the microcap space, and I think that's across the whole microcap universe. And what we're seeing in that microcap space is pretty much disinterest out there, but also the large industry funds are insourcing significant amounts of money, particularly in the small cap space and even into large cap. But so there's a lot of transitions out there. There's a lot of selling at the moment as industry funds insource, and that's putting heavy pressure, particularly on the microcap space where liquidity can be quite sparse. So a lot of pressure in microcaps, but that's presenting significant opportunity. We're picking up fantastic companies, and we'll talk about some of those companies. We think at rock bottom prices, and the market is really, as I said before, quite disinterested in that space. The other thing we've seen is a dynamic where active management, because of this insourcing trend and because of just the sheer flows of money, you're seeing a lot of money go into passive and quant type strategies, and that's exacerbating the issue. We think the market is moving more towards growth companies and away from value. And the value opportunities, there's still good opportunities in that value space, but there's actual quality companies trading at massive discounts at the moment. So real significant opportunity in that microcap space. We fared much better in the small cap and mid cap space, where I suppose most of the money is kind of angling at the moment. If you move to slide 3, you can see what we're talking about here in terms of the disconnect between the small cap market and the microcap market. So the microcap index is that blue index, and the green is the small cap index, and you can see that the larger smaller caps have outperformed, and that's driven up that index, and the microcap component has effectively fallen. So there is a divergence there, and as I reiterated before, that's creating some opportunity in that microcap space. And we'll go through a couple of names where we think there's significant upside in this pack. Flip on to the next slide, which is M&A activity, and Marcus will talk to that.
Yeah, thanks, Matt. So this on slide 4, we've just downloaded some data from Bloomberg to give you an idea of what's been happening in M&A. We've talked about this before, but back to Matt's point on the previous slide, obviously the small companies have done better than the microcaps. Part of that reason has been due to the fact that a lot of M&A activities occurred at the larger end of the small cap space rather than the microcap end, and we'll come on to that in a second. But we think that's, again, a further opportunity for investment because M&A has lagged a bit at the bottom end. And obviously, as the tech rally and sort of, the growth stocks tend to be the larger end of the small cap space, that's dragged that index up a little bit versus micros. But what you can see on page 4 is just what's happened with M&A in Australia over the last 12 years. The dark blue bars there are the total M&A transactions announced, and you can see that actually peaked in 2018. The bars in 2019 clearly are the year-to-date numbers, so we haven't finished the year, obviously, but we think there's going to be a strong pickup in the second half. But you get some sense of just how much activity has been going on and the number of deals, which is at a pretty much an all-time high. And there's no real reason we see why that trend won't continue. And there's really 3 or 4 major drivers there. One is clearly low interest rates, so financing these deals becomes very cheap. Secondly, you've got a lot of investors' money tied up now with private equity, and they've just raised a lot more capital, which needs to be redeployed, and so they'll be looking to put that to work in the marketplace. And then thirdly, you've got domestics and international corporates who are fairly cashed up on the balance sheets, looking for growth opportunities, and will try to exploit anomalies or inefficiencies or cheap valuations. And as we said, we think that they're skewed towards the lower end there.
Just on that point, we have contacts in the private equity space. There is a flood of money out there. I think everyone knows it. It has to be deployed. The private equity guys can't continue to sit on cash. And I think what we'll see public to private transactions. You just saw EQT, which obviously looked under Vocus's bonnet. These guys have not been that active down in Australia. I think recently they sold IMED down here, but it was a separate arm of their business. But we're hearing that they're awash in cash and they're looking for the next transaction. So where this will benefit us is that our process is focused on cash flow. So, we buy companies with good cash flow, and the private equity guys are looking for the same thing as we are, and they try and gear up that cash flow. Gearing can obviously produce significant returns for these guys, and so they are very focused on what we're looking for. So hopefully we see some activity in the second half. I think it's going to be quite active in the second half of the calendar year.
Agreed. Okay, just on GBST, which on page 5, we like to give some examples of stocks we bought and own in the portfolio to give you some insight into the way the team operates and the philosophy of our investment. You can see there on the left-hand side the typical charts we show, which is the cash flow conversion chart. Again, that's just to remind you that's the reported EBIT of the company, which we compare to the free cash flow, which we take from the cash flow statement and adjust the capex and interest to get a comparable figure. Obviously, the company has high quality earnings or high quality cash flow conversion. Those bars should over time match. And we generate this with all our companies that we model, and we can see the history of the company. We like stocks that have a good high cash flow conversion ratio. GBST is one of those companies. You can see the average there is in the high 90s, which is very good compared to many other small companies. And what you can see there is it dropped off in the last couple of years as the company had a bit of a reinvestment period where it had basically underinvested in a lot of R&D and had a large catch up on the R&D side, which saw earnings take a bit of a back step and cash flow temporarily go backwards as they were reinvesting in their core product and bringing it back up to spec. However, the share price, as you can see on the right-hand side, more than reflected this. It peaked in 2015 at almost $7 on some probably unrealistic and lofty expectations around growth. And then as management team cycled out and a new team came in and recognised the need for the capex and the reinvestment, obviously the share price came under massive pressure. And that's when we typically get interested when we find a fundamentally good business with a sound balance sheet that's going through some temporary times that we think are not long-term sustainable. And so in this case, the share price came back a long way. We thought it represented quite good value, and so we bought that for the funds. Happy to ride out a year or two where it had massive reinvestment in R&D, but conscious that the long term that would manifest back in cash flow. What you've seen is the stock bottomed out in the sort of low $1 and then rallied back on some upgraded numbers, and then more recently Bravura, which is a bigger sort of sister technology company operating in a fairly similar space, trading at significantly higher multiples. Lobbed in a bid at $2.50, which saw the shares jump back up to that level. Our view is that transaction makes quite a lot of sense for Bravura. Clearly, we think GBST is on the right path. They upgraded numbers the other day as well, but just shows you basically how the process works. We're not buying the stocks on a speculative basis, but we're buying them on a good fundamental cash flow basis where we think valuations are appealing.
So yeah, we caught up with GBST a couple of days ago, and their pipeline's improved dramatically. The spend is working, and the clients are flocking to their product. So that outlook, as Marcus said, was reinforced by their recent earnings upgrade, and we think they're back on the path or a growth trajectory. So this company is trading on a value multiple. If it starts producing growth, which it appears to be on that runway, then the company could re-rate substantially.
And it's kind of interesting because if you go back long enough, you'll see Bravura actually had the same situation where it had a period of underinvesting in its technology base. It lost a lot of client base or wasn't winning, and GBST was on a real sort of client win base. It got, and frankly, the share prices have reversed. So it's one of those interesting kind of market share swap stories that's coming back our way.
The other interesting aspect is they've got two businesses, and the second business is the capital markets business, where they provide back office software to stockbrokers. And with the ASX looking to implement significant change to their settlement systems, GBST is in the box seat. They're currently the biggest player in that market, but GBST could be in a position to win significant share from the brokers. The brokers do some of their own proprietary software, and that could be outsourced to GBST going forward. So we think there's significant growth path there in that capital markets business. The other flip side to that is that they could sell that business. There would be strategic appeal in that business, and we think that business could be worth anywhere from $50 to $100 million, which would be a significant part of the market cap of the business. And that would leave them with the core business, which is wealth management. So yeah, we think there's a good story here, and we think we're back on a growth path. The takeover activity is interesting because obviously it's seen the share price nearly double from its lows, but we think there's more upside organically in this business. So we're pretty happy where we're sitting in terms of positioning. Just moving on to slide 6, and Mortgage Choice is topical. We took a significant position in this company on the downtrend. Obviously, there was a Hayne Royal Commission. No one expected the trail commissions would get banned. Unfortunately, that's what the Hayne Royal Commission recommended. We thought it was absurd, and we discussed this several times. We think brokers bring competition to the market. When you need advice, you don't go to a bank for a mortgage. You go to a broker. You know you're going to get good independent advice. You're going to get someone with experience who's going to help you through that process. It's a very complex and difficult decision, and that's what brokers are there for, and that's why they've got 60% of the market. Luckily, obviously, the Liberal government came to its senses, and they've ratified trail commissions going forward. So they've kept, they've killed the regulatory uncertainty. The other positive was obviously the Liberal government's back in. The Labor government was proposing moving to an upfront fee, which was about 1.1%, which still would have been very lucrative for brokers, but would have provided less visibility for brokers in terms of their business models. So what we see is basically a ratification or a validation of the model going forward. No uncertainty about the regulatory structure. If you look back at the history of Mortgage Choice, you look at their cash flow conversion, it's fantastic. It's around 100%. It's hard to find businesses like this. They've got a $55 billion loan book, which pays 18 bips a year in revenue, and they take 25% of that. So there's an annuity stream from that loan book. So there's high visibility going forward. They've reset their franchise terms, so they had some franchisee issues last year. Instead of running away and hiding from them, they got on the front foot and rectified the issue. And as I understand, all the franchisees are very happy at the moment. The CEO got a standing ovation, the new CEO, I should say, for making those changes. So the franchisees are very happy, unlike other franchisees in the market, ones at Domino's, for example. And the other thing that you've seen is obviously mortgage approvals have hit probably a cyclical low. If you look at that chart on the top right there, and you look at that the blue line, you can see that settlements, which is equivalent to approvals, are going to be down 10% in fiscal year 19. That's the worst growth the company's seen pretty much since the GFC. I don't think it even got that bad in the GFC, Marcus. Mm-hmm. So we expect approvals to bounce back significantly. You're already starting to see those signs. We spoke to 2 brokers a couple of weeks ago, and they're saying they're seeing a significant pickup in home loan applications, and that the approval process is also improving. So the banks are actually approving a lot more. You've also seen the RBA relax standards in terms of lending standards, which will help help that approval process. So everything's kind of come together.
And a rate cut yesterday.
And a rate cut.
And
the company's on a 10% yield at the bottom of the cycle. If this was at 10% fully franked, mind you, so it's actually paying a 15% gross yield. If this was a property trust, it would be trading at $4, but it's only trading at $1.20 at the moment. We think there's massive upside on a re-rating basis, but also on an earnings, as the earnings increase over the next year or two, as volumes increase for the business. Very sensitive to volumes, of course. So we're very excited about this position. I think we're one of the few institutions on the register, but we're going to get paid to be there when you're getting a 15% yield at the bottom of the cycle. So very excited about this one. The other side to it is that CBA is a substantial holder in this business. They might not be a long-term holder, and that could bring some M&A into the picture, that someone that could actually have a crack at this business now that there's some certainty around the regulatory environment. So there's a lot of positives here. We're very excited about it. And the stock has rallied from...
like 70 cents, 80 cents, go down the bottom.
So it's rallied
a long way. And just on that, we Matt models the stock, and we looked at the worst case scenario. So we had done some work assuming that the Hayne Royal Commission recommendations got up, and as Matt said, the back book alone was worth about $1 a share. So assuming that the business just literally ceased to run, we thought it was worth $1 in the worst case scenario. So at 70 cents, it was trading at a significant discount to all that, and all through this period, it had a net cash balance sheet. So we had confidence that it wasn't going out the back door, and so it's been a good investment. We think it'll rally back and provide excellent returns from these levels. Just finishing off on the outlook now. I think you've got the idea that our view is that microcaps have underperformed. They're more economically sensitive than some of the larger small caps, because they're typically not massively diverse businesses. They're typically quite narrow in a sector, and so they tend to be more exposed to a sort of sluggishness in the economy, which I think has maybe impacted micros a little bit. You got a lot of media stocks and retail stocks there, which drag it down a bit. Secondly, you've had, as Matt said, we think there's been a lot of funds flow from active managers back to sort of passive or index kind of strategies, which has seen money flow upwards in the smaller space rather than downwards, and we think that's creating an opportunity. That bit of a vacuum is creating an opportunity for us to actively look through, where fund managers have been forced to sell stocks at discounts to fair value, and we've seen a lot of lines go through that have created liquidity, and in some cases have given us quite good opportunities to expand our positions in many of these names. We think M&A activity, which has been a very big theme, is likely to continue. Again, it's not exactly what we're looking for. We don't look for companies that can be taken out. We look for a company that meets our criteria. But it just so happens that criteria perfectly matches with many of the takeover stories and criteria that private equity and corporates are looking at. So valuations are clearly important for that, as is cash generation and strong balance sheets, all of which are right in the crosshairs of our investment process. And then lastly, with the rate cut, which it's a low base already. Obviously, interest rates are not exactly high, but a small reduction there. It is small. It is stimulatory to the economy, particularly around housing, which has been a big drag on the economy for the last 18 months. And we think the political certainty we've seen now with Liberals getting re-elected should see more confidence return to both business investment and potentially consumers, which is a positive again for micros and for the smaller end. So that's really our outlook. We're very comfortable with where their funds are positioned. Almost all the stocks we own in the top 10 are net cash balance sheets. Just to reiterate, valuations and cash flow generation across the whole portfolios are appealing for us. So we think all the funds are well positioned to benefit looking forward.
Thanks, guys, and always great to get your insights on the opportunities within the small and micro cap market. Just a reminder, all attendees have the opportunity to ask questions via the chat box on your screen. Look, while we wait for some questions to come in, I thought I'd just outline how we see Spheria being used in portfolios. Firstly, the Spheria investment approach, the team invests in businesses that generate strong cash flows, low or no debt, and strong balance sheets. And a lot of our investors state that one of the things that really ticks their box is that the Spheria approach really passes that sleep at night test. And that means that the Spheria small micro cap funds and the mid cap fund really sit as a core allocation within those market cap spaces within your portfolios. In addition, the Spheria team have a very open-minded approach to investing that really leaves no stone unturned in relation to the fact that the guys look at both growth and value stocks. and they also look at stocks across all sectors, which is fairly unique within the small cap space, with most managers either bending towards a value or a growth tilt. And finally, you're investing with a team that has a huge level of experience and a long track record of delivering outperformance within smaller microcaps. Hopefully that summary provides you with a bit of context as to how Spheria fits within portfolios for your clients. But we have had a couple of questions come in, so we'll kick off with those. I'll combine a couple of questions here. Guys, the wax stocks are getting a lot of headlines. What are their valuations, and what's your view on them? And I'll just explain for anyone who doesn't know what the wax stocks are. They're a collection of stocks based, I suppose, a little bit on the FANGs in the US, a couple of tech-style stocks in Australia called WiseTech, Afterpay, which many of you will know, LTM, Appen, and Xero. So what's your view on those stocks? What valuations are they on, and go from there?
Yeah. Okay, thanks for the question. Look, as you'd probably expect me to say, and Matt to say the same thing, by the way, wax stocks are a combination of some interesting businesses, but on astronomically high multiples generally. Some of them don't make cash flows. So we've found a lot of them hard to buy at the moment, and we think they're all trading at levels that are incredibly lofty compared to their own histories and compared to the histories of other companies that are comparable overseas. And we've seen this periodically in the marketplace before. The nearest proxy we think is the 2001 tech boom, which we saw here and globally. Many of the sort of go-go names then got to really, really high multiples in the 70, 80, 90 time multiples looking forward, which are roughly where many of these stocks are trading now. And it just became very hard for the market to sustain those multiples when earnings growth slowed. And so many of them came from their peak down to 60, 70, 80% down from their highs. And we just think there's a real danger that many of those wax stocks will have something akin to that occur in the future. We've managed to perform well despite not owning many of those stocks, largely because we've picked up some great names like Technology One last year, TradeMe, a bunch of other names that were allied to technology, but just on much more reasonable multiples with good cash flows, and they've re-rated and performed very well. So it hasn't cost the funds, and we think we're playing a much safer game by not being invested or exposed to those stocks.
Interesting. I think a couple of webinars ago you guys talked about those stocks that were in the tech bubble and how long it took them to get back from a valuation perspective. It was...
Yeah, I think it was Tech One took, I think it was nearly 10 years. So it got completely overvalued in 2000, 2001. It didn't miss a beat for the next 10 years or for the ensuing periods. Yet the stock derated, I think it was nearly 80%, just because it got overvalued. So you can have a great company, but if you pay too much for it, you can be making a serious error. And I think a lot of people that bought it at the top in 2000 wouldn't have held it for 10 years.
Yeah.
They would have sold it on the way down or at the bottom.
Yep.
And actually nothing had changed with the business, just the multiple got cheaper.
Yep. I'm going to combine another couple of questions here. Guys, great to hear your insights on some of the non-banking financials. I would have thought Class would have rallied strongly post-election with SMSFs and family trusts looking at a much safer investment from the perspective of the Liberals being in. Have you guys taken opportunity to add to your allocation?
Yeah, look, we've increased our position. The company's sitting on $20 million of cash. It's got high visibility on its revenue and obviously on its cost as well. I mean, its revenue is, its retention rate is over 99% for its customers. There's a bit of competition for them around, but they've got the best product in the market, and I think over time they'll continue to take share. Obviously, with family trusts and franking credits being ratified by obviously the Liberal government, that's put the industry under less pressure going forward. There's a lot of propaganda out there from industry funds at the moment, and they're pushing the barrow that they're winning a lot of ground from retail and SMSF. But we think if you look long term, that people won't want mediocrity. They'll want a lot of people who are more sophisticated will want to run their own money. They want to have their own flexibility as where they invest that money. And we think SMSFs will continue to be attractive.
And the visibility, frankly, on what's in the portfolio.
Yeah.
Which you don't get necessarily in industry funds. So.
And the cost of managing an SMSF is going to fall. I mean, Class and its competitor products are actually lowering the cost of administration in the industry. We think SMSFs are going to get cheaper and cheaper to manage over time, and that's going to make them a very attractive proposition. So we actually think the superannuation market will probably split between two. It'll go industry funds and SMSF, and retail funds will probably disappear to a degree.
Okay, guys, I've got a question just in relation to explaining a little bit more on the comment you made earlier with respect to industry funds insourcing and what that impact has had on small, mids and micros.
Sure.
Yeah, so the large industry funds like Aussie Super, Rest, Host Plus, the really big ones are insourcing. So they're taking managers out of the market, and they're employing them internally, and they're managing large cap Australian equity, small cap Australian equity, micro cap Australian equity. But in most of those cases, these funds are so large now, they're effectively passively investing per se. And that's going to provide us opportunity. If all these funds are just investing on arbitrary indexes, which is pretty much what they're going to get to, we can obviously make money around the edges by employing our process. So we actually think it's a good trend for us. I think people that are logical will support active managers going forward, and we think active managers in this space can make a lot of money.
Well, they have. Exactly. Historically. I mean, active management has significantly beaten passive and smalls for almost every time frame over the last 10 years. And we think that just exacerbates, as Matt said, we think that it creates more opportunity for us. We're getting good chances to buy some of these forced redemption or forced sales. And given that most is going to the larger end, which is got a good chunk of the wax component, we think it's probably not the right time to be investing in those stocks. So it's ironically it's going to be a good long-term trend for us, although it's somewhat challenging short-term.
Yeah. We think it's just temporary. The underperformance we've seen in micros is temporary, and we actually think we'll get significant outperformance going forward, just from this aggregation of demand in that sort of larger small cap end. We think it's dangerous, and Marcus talked about the overvaluation you're seeing, and that's more pronounced by insourcing, by passive, by quant. They're all just going into the same place and presenting opportunity outside of that.
Okay, let's move on. Guys, you mentioned the federal election. Was your allocation to HT&E based on a massive advertising resulting in and around the election?
No. HT, it's obviously the leading radio business in the Australian market. It owns KISS FM and WSFM. So it's got two of the leading stations in the market. We own it because it's got a bulletproof balance sheet. So they sold Adshel last year, and they sold it for a mozza to OML. So a significant price. They've got net cash, and they've got radio assets which produce a significant amount of cash. The radio industry has been resilient over time. You haven't seen the audience drop away like you haven't seen with other mediums. You've seen strong audience growth in that space. So it's pretty much rivers of gold for us owning that business, and it's really cheap.
It's buying back stock. So they bought back 10% of its stock over the last 12 months. And it's just refreshed the buyback, Matt. So
that's correct.
And the only uncertainty really around is a tax issue that is disputing with the ATO right now, which they're fully provided for. And I think we fully provide for on a very conservative basis in our valuation, and we still have massive upside. So we think it's been hit on cyclicality a little bit. I think with that, as the economy going through that uncertainty period, people fall back a little bit on media spend. But frankly, it's been pretty resilient, even though the top line's come back a little bit.
And the feedback we get from media agencies is things are picking up. So obviously the election was a bit of an air pocket for the media industry, but post that you're seeing a bit of a pickup. We think radio is going to benefit from that, and most advertising mediums will benefit over the next 6 to 12 months. But even on the long-term view, I think radio will be around, and you can see that there's significant upside in this business. It's trading at about 7 times EBIT, so it's about 10 times PE. I think historically it's traded much higher than that.
Okay, guys. A couple of questions on Essentia Group and an update there in terms of your views and in the portfolio and what you see playing out there.
Yeah, so Ed Harrison's the new CEO. He's doing a very good job, we're hearing. He's cut prices, which has caused some angst amongst competitors, but we think that's a sensible strategy. We think previous management teams were overcharging for the software. And so they should stop the customer attrition. If they can stabilise the customer base with some price cuts and obviously rolling out their new product, which they're doing. And also they should get the benefit from the copyright costs coming down as well. So obviously that's been through an arbitration court system, and it looks like that's going to be a favourable outcome going forward. They're paying about $16 million in copyright to News Corp Fairfax predominantly. Based on the decline in traditional media, they should probably be paying half of that. So if they can recoup some of that cost, it's going to go straight to the bottom line. Plus they're stabilising their customer base, and you should see the business sort of come through that inflection point now, where I think it's rebased and looking like it's going to start to grow earnings over the next few years.
Okay. Question on financials again. With APRA rules changing, have the earnings and outlook for the smaller banks improved enough to get on your radar?
Smaller banks, yeah. Look, there is some capital relief potentially coming through, and there is a relative capital impost for the smaller banks versus the larger banks, which makes it difficult for them to compete with the larger banks. So any sort of harmonisation in the industry will be quite positive. Yes, we look at smaller banks. We own one smaller bank in our microcap fund. We're looking at the other ones at the moment. There could be, obviously, the macro environment's picking up with the interest rate cuts we talked about before. So they do look more appealing, and plus you've seen a pretty big retracement in some of those names.
I see Pacific Smiles is in the portfolio. Is that a stock that you guys have invested in as a more of a roll-up story?
No, it's a roll-out. Pac Smiles has always been a roll-out as opposed to a roll-up.
Yep.
So the big difference there is that you know what you're buying, because you're not buying, but you're rolling out. You're creating greenfield space. Excuse me. As opposed to buying someone's business where you don't really know what's in the books. It's had good revenue growth. It just has struggled to get the EBIT growth it probably should be getting. So it's pretty cheap at the moment. We think it's differentiated in terms of quality because it's a rollout as opposed to roll-up. So it just takes a while for those new stores to kind of mature, and that's been the drag on the profits for the last couple of years.
So one of the positive dynamics in the dental industry is there's more females involved in the dental industry, and they want to work more part-time and casual work. And obviously, Pac Smiles can provide that. They provide, the clinic effectively, and they provide the demand. A lot of the dentists these days don't want to be managing their own businesses. So as Marcus said, Pac Smiles don't buy dentists. They just provide an offering which is very attractive, and they're seeing good take-up.
They bought one in the last history, but it's 99% rollout. Yeah.
When they do buy, it's more for location, just to get into a location rather than actually buying a dentist.
Yep. Okay, and probably last question, because we've had a heap of questions come in. Guys, have you been holding any more cash in the portfolio as the market's gone up over the last especially the last 2019?
Yeah, obviously, we were deploying cash in December, January, so we ran down the cash levels. We have been increasing cash levels more recently. The reason for that is we do have distributions to be paid in July, so that's going to be a withdrawal on our funds. But just also some of the valuations have got stretched on some of the companies we own. So we were buying like a Breville Group at $11 not long ago, and it went to $19. It got really expensive.
Tech One went from low fours to over $9. We're trimming that back a little bit.
Something else. Invocare, we were buying at $10 or $11, and it's gone to $15, $16. Iris, we were buying, I think it was at 11 or 12 not long ago, and it went up to 15, 16. So we look to take some profits there, and obviously we do have those distributions, but tactically we think it's sensible to have some cash around, because there are some opportunities down the microcap end, and obviously with the transitions out there, we need the liquidity to purchase those positions.
Thanks, guys. That is all we have time for today. We haven't got to your question. We certainly will come back to you. Just in terms of today's webinar, we'll be making it available on the Spheria investment website, which is www.spheria.com.au. We'd certainly like to thank everyone for their participation today. Some great questions came in, and we look forward to talking with you in your office at our next luncheon or webinar. Thank you very much, and have a great day.